Hi, so your trading strategy just lost you money in live trading? Years of data backtested and now this? What most traders and funds would do is just panic, throw away the strategy and start over. But what if you can salvage your strategy? What if the logic isn't the problem, but just your plumbing? So keep watching and learn how to salvage your trading strategy. So what's the core problem? The core problem is that once you see that in live trading or paper trading, it didn't exactly work as you had hoped, you throw it away. Where you spend weeks and months on development time into perfecting your strategy, and then it doesn't work out. And that can be for a variety of reasons. For example, slippage can reduce returns per year by 0.5 to 3%. And that's just one of many examples. But the core problem isn't your trading strategy logic, it's just your execution framework. So here are some immediate technical fixes that you can apply to potentially fix your strategy. So number one is widen your entry signals. So if you have a signal that in backtesting works perfectly, for live trading, adjust it by 2 to 3 basis points, such that it has a bigger tolerance. Produces more signals in live trading, and that just accounts for stuff like, for example, execution lag or market movement between your order that you do in your own system and it arriving on the market. And this way, you can already try to improve live trading performance. And another thing to ensure you still get favorable prices despite, for example, market movement is your order execution framework. So, for example, instead of always using market orders, what you can do is use adaptive limit orders. And then, for example, every 200 milliseconds or any number that you figure out works really good for you, get closer to the market price until you hit a limit, so to speak, of what's tolerable to you. And high frequency trading, especially, of course, is affected by these order execution problems and market impact. And this especially shows you how important it is to model market impact very well in backtesting. However, there's things you can also do in live trading to prevent having or moving the market against you when you want to enter. For example, capping the position size to a certain percent of your daily trading volume, or for example, scaling position sizes not with the entry signal strength, so how confident you are you will make a very good trade, but with the available liquidity. And in trading, it's oftentimes the case that you don't have gigantic losses as one-off, but at the end of the day, if you have a big loss, it's more the reason of many small losses basically adding up. And in order to prevent those, what you can implement is, for example, monitoring that stops basically the execution of certain strategies if during the day they underperform. Although you have to be a bit careful with this because maybe they will have a turnaround and start being very profitable again. So it's a bit of a tricky one with this one. What is probably always a very good idea is to monitor at what price your orders actually get executed. So if it's consistently, for example, more than 15 basis points away from what price you would have liked to have, if you use market orders, then it's probably a good idea to hold your strategies and just stop trading for the day or until it gets better. And then this is a really big one because you want to probably reduce the number of trades you do. What might sound a bit counterintuitive at first actually makes a lot of sense because you of course only want the highest quality signals to actually get turned into orders and positions because it's just the most likely they will turn into a profit. You of course also on the other hand want to use all your available capital to trade because that's how you make money. However, the rule of thumb that's quite useful is to reduce the number of trades from backtesting to live trading by 30 to 50%. And then another one that's less about fixing your strategy but still really important is just maybe adjusting your expectations. because a strategy that, for example, backtests at 40 or 45% return per year might in the end in live trading only turn out to give you a 25% return. And that's still really good alpha that you shouldn't just discard because it didn't meet your high expectations. And so basically try to perhaps adjust your expectations for live trading. Okay, and the last technical fix is to have way more realistic backtests. So look at your modeling for slippage, fees, latency, things like that, and try to make it as realistic and conservative as possible. Because if you, for example, overestimate the slippage or latency or fees, but you still turn a really good profit in backtesting, it's way more likely you're going to turn a very good profit in live trading as well. So the overall conclusion is basically to fix the plumbing, but keep the engine. And smart funds don't just scrap their strategies if they don't exactly meet the expectations. They adapt them, okay, and they make them better so that they still return alpha and make a profit with them. And the key here is patience, because Rome wasn't built in a day, and perhaps even if you have a really great backtest, the first time period of live trading with that strategy won't perhaps turn out to be profitable, but probably that's fixable. So in the end, it's about adjusting your mindset and adjusting your strategy in more ways than one. And yeah, I hope I was able to help you a bit salvage your strategy that was perfect in backtesting, but maybe not so great in live trading. And if you're an institutional investor, head over to autotradelab.com and schedule a call with me. I would like to chat with you. And otherwise, thank you so much for watching. Hit the like button, smash the subscribe button, and hit the bell. And comment down below what you think are other really great tips. Thank you for watching.